Situational awareness for June 28, 2016. As you can see that in the last 2 days there was a big sell-off, primarily because the market was surprised. Before that, if you see, the market was, this is a Dow Jones US total market index, but you can look at any index, is the market had this big bounce, and after that it was just going sideways. It had formed a range, and then the range has now been broken. Basically, that's what we see. The market has had trouble since 2015 in making a convincing breakout. If you see, this is where the on a weekly basis you'll see much better. Like if you see here, this is the high on the total market, which was established somewhere here, and since then the market has been just going sideways in a range, and every time it corrects it bounces back, but the bounce cannot really take the market higher or break the range. Basically, that's what has been happening, and which is true of all the indexes. If you see the NYSE or composite index or 100 Nasdaq 100 or small caps were actually underperforming the market. If you see small caps, while the other indexes were nearer to the high, the small cap had put in a high here, and since then they've been like are down around 15%. So they've been lagging since this top in them, which happened somewhere in June of last year. So that's where we are in terms of like situational awareness, that basically the market has been range bound. The S&P was the one which is almost about to break its high, but every time it has tried that, here it failed. Here the rally petered out. Even before that, here again the rally is under pressure. So that's been the underlying theme. And also, if you actually look at it, this is where the Fed stopped the QE, or like the QE3 got over somewhere here, and since then the market has been in a sideways kind of a move. All along the QE was going on, QE1, QE2, 3. Now there is no quantitative easing basically. So now let's look at T2108, because this is really more actionable than the indexes. Like when it goes below 20, you will find that that tends to be from where bounces happen. And so this is like, if you see this level of around 20 is where most of the bounces happen. It can go below 20, but 20 has been like one of the most reliable kind of an indicator from where. So we are approaching that. We are at 27, not really there. The other thing is T2107, which is percentage of stocks about 200-day moving average. And as you had seen here, we had almost reached 70% of the stocks were about 200-day moving average. And as against that, if you see this background here, since 2015, like the peak was formed actually after the market had big drop. It like, and I went all the way up to 93 or 94, but after that, since 2015, actually here there were only like 58% of the stocks, and then at some stage only 10% of the stocks were about 200-day moving average. And in the last this bounce, a lot of stocks had recovered. So that backdrop is much better than 2015 or 2014, where it was really struggling, or the number of stocks about 200-day moving average was kept on deteriorating as the market tried to recover. So here at least you have more stocks, or at least 50% of the stocks are now above their 52 moving average. But none of these are going to help in the short run. Like T2108 is what really tends to work. At the same time, this is not the only thing which you can look at. You can look at market monitor, and when you look at market monitor, typically markets like top, or they correct when there is an exhaustion of buyers, and the best indicator of that, or like when there is like buying euphoria, and then that buying euphoria exhaust, like you saw a reading here. And if you see after that the market started correction, similarly you had this high reading, and then you'll see that there was a little bit of correction. So the number of stocks of 50% has been the most reliable since 2009. It can go up when there is a big bounce like here. But once the market has made a 20% move, 15-20% move, and then it goes into this kind of a extreme, then you will see that it tends to lead to a correction, not necessarily a top, but a correction. So you have ample warning that when it reaches about 20, that there is likelihood of a correction, and it works, and you can see that for yourself. So that's how you can use market monitor to proactively look at things. Now you will see primary breadth has turned negative. This big selling has really created that situation. But before that itself, you had seen that the market had put in a top in terms of primary breadth around 1880 or something like that. And since this time, like say this is where, since then it has not really, and at this stage the primary indicator also went into an extreme territory. Anything reading below 200 on this, when like number of stocks down 200 it goes below 200, that's also another indicator which tells you that there is an extreme bullishness, and it tends to lead to an exhaustion of buying, and then that leads to um, correction. And that you will see here also, like this. So you had two clear warnings, or like the signals, which is basically you had this one signal which is very rarely it happens. So it told you that look, and there is likelihood of a correction happening. And if you see, like a lot of people at this stage would be very euphoric, saying, oh, it's going to break out to the new high, there is going to be a this, and this is the time to be fully invested. That's how the market works basically. Buying exhaust itself, or buyers exhaust, buying exhaust. Similarly, selling exhaust, like if you get more downside, and if these figures go below 200, then you will see that there will be a selling exhaustion somewhere. Here you had like that kind of a situation where there is a selling exhaustion, and you see selling exhaustion happened with number of 300 plus day. Here you had only 2 down days basically, but the indicator, the breadth has deteriorated sharply, and this you'll see on this one also. Like here you had 1800, here we had, because this takes a smaller time frame, around 2500 or 2400 is where it picked. And since then the market was deteriorating. 2600 is the high reading. Since then the market was deteriorating, and that you could see in the sideways move, or the range which was getting formed. This is weekly. If you see on a daily, this was the big bounce, and after that it just petered out into a sideways move. Now that sideways move could have continued for a long period of time, it could have broken out, or now there's a correction. Now short term, immediately today you see the futures are up. That is something which is a classic bounce in a down move. Many times it happens. You can have a bounce like this, and then there's a retest, or many times you get a bounce early morning and then it can fade also. There are many possibilities which happen, but obviously because the market was down so much in just 2 days, there is a bounce. But does it mean that it is safe to go in and start putting in like swing trades and all? That is what you need to ask, because unless you're a day trader, in which case you would have anticipated the bounce and entered yesterday or late night or whenever. But as a swing trader, the risk is much higher here of any swing failing, because there is a lot more volatility. So you have to wait for a signal which will tell you that it is much better to get into the market if you get a breadth reading. Supposing today you get like 800 900 stocks up 4% plus, but that is just an indicator that yes, buyers are coming in. Absent that, if you get a bounce and you just get around 200 300 stocks up, that tells you that the buying was not really powerful, because you had cumulatively in last 2 days around 1600. If you add, this is like rounded up to 1600 plus 332, around 1900 stocks down. And as against that, if you just get a weak buying of 100 200 or these kind of days, it may not be sufficient to signal a turn. As against that, you want to see something 775 500 596 in a short period of time. If you get like a significant amount of buying, then that might be a better situation. So you have to go by the situational awareness, depending on what is the setup which you are going to be trading. If you are going to be trading day on an intraday time frame, your situational awareness is different. Your situational awareness might be there is a bounce and I'm likely to fade it, because you're looking at an intraday move, you're not looking at a longer term kind of a thing. As against that, if you're looking at swing trading kind of a situation, especially on the long side, what you will see is that unless there is a buying and the selling completely exhausts itself, uh, many breakout may not follow through. So either you'll have to be really proactive in getting into a move very early and have a very small profit target, or wait out some period and see and watch, which is what I am going to do. uh, if buying comes in, you will know, because there will be improvement. In this same way, you will see an improvement in T2108. If you see, like, when there is a turn, you see really big figures, like you see 34% jump in breadth in one day in terms of the percentage of stocks above like 40-day PMA. So that is like the kind of things which can happen, or in T2108 near the turn, like here again it was up 62% in one day. So if you get that kind of a big reading, then look, and there is genuine buying coming in. Absent that, more likely that stocks which had dropped in the last 5 days. So let's look at, say, the universe. Universe is basically liquidity universe. Liquidity universe is basically the total stocks, and liquidity is true, which is basically liquidity true is a condition which is the stock had at least 100,000 volume uh, in the last 3 days. So if you can see the liquidity condition, so liquidity condition, invariably somebody will ask, uh, what is liquidity condition? Liquidity condition is basically something which tells you that what was the volume on the stock. uh, why am I doing that? So if you see, the liquidity condition is basically in last 3 days, barring today, the stock must have traded 100,000 shares. It has to trade 100,000 shares. So that way you're ensuring that stock has enough liquidity, or at least that's the amount of minimum liquidity which you want to see. So what it says is that as of today, the last 3 days uh, of trading, the stock traded at least 100,000 each of those days. So if you look at that, and what I'm going to do is I'm going to like and sort that by 5 day, which is basically C divided by C5. So to look at what stocks were up and what stocks were down. So you had like some of these smaller stocks which are up, like say the biotechnology stocks, or some stocks which had a buyout, or this Zedge. Uh, so these are stocks, like some of the biotechnology stocks were still up. They were performing well, uh, and that smaller cap, the gold stocks. But like really, if you're looking at from a shorting point of view, if the market continues or the bounce fails after a couple of days, and the bounce is a big bounce, is that what you're looking at is something where the stock has gone down a lot in the last 5 days, and then it has a counter trend bounce of 3 or 4 days, and it bounces back. So say something like emergent buy solutions, like stock has a big drop. Now it is likely to have a counter trend move, and it might fail. So you're looking at say even some of these oil and gas stocks, as you can see, they will have a move where uh, they will bounce back, and then that move will fail, especially for stocks which were making a high and then had a breakdown in recent days. So all these are stocks which, if you look at on a 5 day time frame, these are stocks which are making a big drop, because stock like this was down around 25%. So these are the stocks which you will see that if there is a follow through, they will have a follow through on the downside also. The other way of looking at that is like some of the stocks which are up a lot and which are correcting. If those breakdowns, if they might have a continuation kind of a breakdown. I sorted by MDT. So if you see some of the stocks which break down here, they will have a continuation. Same way, what you can look at is stocks which are holding up relatively well. For that, what we do is we look at MDT, and if you look at MDT bullish, which is basically for MDT bullish, what we are looking for is a stock C divided by average C. 129 is 126 is about 1.19. That means like the stock price is 19% above is 126-day moving average. So that tells you there is a momentum. So if you look at these stocks, 223 stocks are the stocks which had basically momentum on a 6 monthly basis, and see this stock is going sideways. Now some of these stocks are likely to be the one which will break out. Obviously this is a buyout, but if you go through this list and look at what is setting up, and you're looking for basically a setup like this, if it is going sideways like this, then that is a stock to put it on your watch list. But again, I would not be in a hurry to get in unless the overall trend become much clearer. Just a bounce on pre-market is not likely to be immediately actionable. So you have like this SCLP going sideways. So you'll see that the stocks which have momentum, some of them will set up there, some of them will not get sold, and they will start breaking out. So that's one way of looking at it. What we have seen typically is during the market corrections, or like when the market bounce back, like when the market bounce back here. Uh, See, what you'll see is that when the market bounced back here, it's not really the momentum stocks which led this thing. What were the sectors and what were the stocks which led this advance was gold. And if you see before that, like the gold stocks were in a downtrend. They were not really, they didn't had momentum, but they are the one which made the biggest move. Or if you look at, say, stocks like FCX, which basically was going down and it made the biggest move. So stocks which have the momentum or which are going up the most or which have MDT are not the one which are going likely to bounce back. Typically this has been the behavior of the market since 2010 2009 bottom, which is basically stocks which are beaten down the most, they tend to bounce back the most. If you, and you can see this better by looking at, again, going back to the liquidity universe. And if you look at the liquidity universe, and I will sort this time by stocks, by YTD, the stocks which are up the most by YTD, which is the system build criteria. And if you see, most of the stocks which are up a lot were the stocks which are down a lot. See here, stock was down like almost 50% plus, and then it bounced back. Or even if you see here, the stock didn't had a momentum at that stage, it was like in the downtrend. So my point is, look, just looking at stocks which have momentum, which are just going sideways here, may not be the best strategy. You have to just go by what is bouncing back. As you have seen, the tendency has been that whatever is down, like this stock was down, this stock was actually, if you see here at this stage, was down around 66%. That's the stock which bounced back. Or even IAG or TCK Resources, if you see, the stock was down almost 70-80% or 90%. And it has bounced back. So whatever is beaten down might be the one which will bounce back the most. So how do you find those beaten down stocks? You can have all the indicators to look at. Like you can look at whatever is down the most in last 10 days. So you can, like, and again go back to our liquidity universe and look at whatever is down most in 10 days, and that is likely to be the one which will bounce back. So that's one way of looking at it. Or like, say, what is down most in 25 days. So that's like, can I say, anything which has lower value is down a lot, right? So these are the kind of things which might bounce back, because that's been the tendency of the market, where the beaten down stocks tend to lead the rallies coming out of a range. Because we've been range bound, you'll see that the beaten down stocks are the one which tends to bounce back. Or you can go YTD and look at, like, whatever is down the most, like, say, stock like VRX is down 80%. So that is likely a candidate which might bounce back more than something which has been holding up well. Stocks which are holding up well will also bounce back, but like the tendency has been, and this you can look at yourself, the stocks which are down the most tend to bounce the most in most of these at least in the short run, when these bounces start in the indexes. So basically have both open mind, like, and look, whatever has been beaten down or junk is the one which will bounce bigger and make bigger moves than something which is basically holding up well. In fact, and stocks which are holding up well during this bounce, which came out of the bottoming process, actually struggled they didn't really make any big moves. Most of the growth stocks and the momentum kind of stocks, while stocks which are really beaten down, like you had a stock like X, and if you see X was down like almost in a year, almost around 75-80%, and then the stock doubled. So look at stocks which are down. I'm saying situational awareness term, because that is what has worked in the market, and that is what you can see by using any one of these indicators. So to just summarize, from a situational awareness point of view, there is likely to be a short-term bounce, but whether that is a endurable bottom, we don't know. Breadth has to improve for that to happen. During this kind of bounces, stocks which are beaten down tend to perform better than stocks which are held up well, at least in the initial phase of the rally. So look at both stocks which are beaten down and also stocks which are held up, and then those are the stocks which are likely to read. But before you make any decision as a swing trader, let the breadth improve, or at least see signs of breadth improvement, which will be like, say, either T2108. If it breaks, is up like, say, 50%, 60% today, then that will tell you that there are buyers coming in really hard. Like here you had like an, say, 69% bounce in T1208, or 34% bounce here. Or you want to see breadth on 4% plus of, like, say, here if you get like, say, a 700, 800 day or 500 day and followed by another 500 day, then that will tell you that genuine buying is coming into the market. So that's as far as situational awareness is concerned. I would be cautious unless you are a day trader, because the backdrop to this move is that there was a big bounce and it struggled for some time, and then it is breaking down. So this might be a correction which might be the first leg of the correction, then you get a counter trend bounce and it fails, or it might be that the market just ignores Brexit and it goes on to make a high. But we have to be flexible, and you have to keep in mind that we are looking at specific setups, not really the market. So within that, you're going to be looking at setups which might be anticipation setup, or 4%, or a dollar breakout to enter or short. But the overall market can be something which you have to take into consideration, at least when you get a dislocation like that, and not really jump at every breakout till the picture clears a little bit.